Hi, this is Kerry Artak with Artak Advisory, and this is the AgriTalk video supplement for Monday's show, Monday, May 3rd. In it, I cover three markets: July corn, July soybeans, and June live cattle. Before I jump into it, I just want to encourage you. You're probably at the website right now. Please fill out the free trial form. First name, last name, email address, a phone number. Would love to get you to check this out for a couple of weeks. No obligation, no credit cards needed. You won't get, I won't bother you with repetitive phone calls or emails. It's all in the up and up. And, during that time, you'll have 2 weeks of unfettered access to everything that I produce day in, day out. You'll also get a call from me. We can talk about your trading or hedging needs, what your view is of the market. We can square that in relation to mine. There could be a benefit for the free trial, even if you don't sign up to become a regular monthly subscriber. But obviously, that is my goal, that you become a regular monthly subscriber. I'll jump into the analysis now. Let's jump right to July corn. And what you're looking at right now is a weekly continuation chart that's based on volume rollover. So when July recently exceeded May contract volume, July became front and center on this chart. There's, a couple of different ways to produce a long-term continuation chart in the futures markets, because they are nothing more than the stringing together of previous contracts. You can do the traditional, which is, where May would still be reflected on this chart. It would be much higher, actually. But I like to, quote unquote, follow the money, if you will. And that is to say that the high volume contract is always reflected on my continuation charts. And I think it's a more accurate way to gauge trend dynamics. In any event, on last week's show, I mentioned that had we closed above the 644 area, 644 and 3/4, I think last week, that we would have a meaningful secondary buy signal, longer term, a 3 to 5 month buy signal. Initially, we had one in December when we settled above this horizontal channel top. The target being then, in December, this long-term speed line and combination Fibonacci retracement in the 640s. Well, we pushed through that last week, and now we're in a secondary long-term buy signal. The next 3 to 5 months expected to reach 834.5. And that remains in effect now, as long as we continue placing weekly settlements above 644.25. This is a dynamic approach. The speed line is dropping gradually, and it will change over time. At this point in time, it's just called the low 640s. Holding above the low 640s, this market should continue to 834.5, this extreme channel top, where I would expect the market to top out on an annual basis, possibly through next year, possibly decade long. Difficult to say. If, however, we close back below 644.25 at the end of this week, July contract, we should fall back to not only 579 even, which is the 50% Fibonacci retracement level from the 2012 high against the recent 2020 low, but also I think the market will likely fall back to this trend-defining rising speed line. I'm not going to get into speed line analysis, but it is a trend-defining instrument I've used for years, and it's not altogether different than that 579 level I showed you in the previous slide. 568.25 is the base of support that I would expect if we close this week below 644.25. And I would expect it within as little as 2 to 3 weeks. 568.25, able to contain selling through summer trade. From here, the market can consolidate and push upward and onward to new highs, perhaps, over the following weeks. But if we close below 568.25 at the end of this week, and this speed line is rising through time, a dynamic approach once again, if we close below it, the party is over, in my opinion. The high is good for the year, and we should then fall all the way back to this 464.75 base of long-term support, which I'm calling the new floor of long-term support for the broader corn market as we look ahead really into later decade. I would expect this within 3 to 5 months of closing below 568.25. Let's continue on to the soybean market. Big picture, we remain bullish, anticipating 1656 even as an ultimate objective. We're not far from that right now, and this has been in effect really since closing above 1133 even in November of last year. About 6-7 months ago, we closed above 1133, and this extreme channel top became the long-term target. At the time I was mentioning, as little as 5 to 8 months, possibly a year or two, depending. As it turns out, it's more like 5 to 8 months. This 1656 even remains a 2 to 3 month target above 1405 half. So the market has room to fall back to 1405 half, perhaps, over the next few weeks. And there it finds support that can absorb selling through summer trade, and above which 1656 even is expected by the end of summer. So if we did fall back to 1405 half, the market can round back up and push onward to 1656 even over the following 3 to 5 months. If, however, we close below 1405 half at the end of any week, and this ascending channel bottom is rising weekly, by the way, it changes every week, then we do indeed have a good annual high, in my opinion. The market then likely to fall all the way back into the 1130s over the following 3 to 5 months, where I would expect the soybean market to bottom out well into next year. Now, upside, I do have an indication for testing 1656 even near term, and that would be a settlement at the end of this week above this ascending channel top at 1554 and a quarter. If that does happen at the end of this week, I do think that the 1656 even formation would become 2 to 3 weeks away, where we can top out through the rest of the year. I'll mention that if we did close above 1656 even, I do have a 1950-ish target that I'm not even illustrating. I just wanted to put it out there. I do have other upside objectives if 1656 is taken out. But for right now, this is our target, and this is an annual containment area. And once again, it becomes a 2 to 3 week objective if we close above 1554 and a quarter at the end of this week. Until then, 1554 and a quarter can contain weekly buying pressures, and below which I tell my subscribers we can fall back over the next few weeks to this 1405 half formation. So that's the near term outlook. Finally, live cattle, June live cattle. Several weeks ago, we settled below this combination speed line ascending channel bottom this week at 1840. This is our ceiling through summer, and below which I maintain a sell signal that's longer term in scope, the next 3 to 5 months, anticipating 97 handle support, or wherever this rising 2/3 speed line is at time. It is rising about a half point a week, and it remains a 3 to 5 month target below 118.40. So bearish June live cattle through summer trade, and I think price erosion will be the name of the game here as we continue into summer trade. Being hedged is important right now if you're a cattle producer to the downside, anticipating 97.42. Inversely, if we close the week Friday above 118.40, the market has shrugged off a long-term sell signal, and with that, I think the capacity for gains into summer trade is likely, and I would expect at least 123.65 for the June contract over the following several weeks, where, by the way, the June contract can top out into expiration. But FYI, if we close Friday above 118.40, the broader market, i.e. the August contract, has the capacity to continue onward and upward over the next 3 months into the mid to upper 130s. 137 would be an extreme. There's a lot going on at 136 half that I'm not even showing, a long-term channel top that goes back about a decade and a half of trade. So bottom line, with live cattle heavy below 118.40 through summer, expecting 97.42, and the August contract, by the way, will inherit these levels when June goes off the boards. Inversely, closing above 118.40 would be a failed long-term sell signal, and in essence, I consider failed long-term sell signals to be a valid longer-term buy signal, and that should then yield for the June contract 123.65, and the broader market, August contract, October contract, in reach of the mid to upper 130s over the following 3 to 5 months. And that is all I've got to say for this week's AgriTalk video supplement.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You've nothing to lose and much to gain.